Now the topic before us is understanding bank's contribution to the money multiplier. Banks play a very important role in the money multiplier process. Banks act as intermediaries between the depositors and borrowers. Now, first of all, we will understand the role of the banks in the money multiplier process with the help of an example. As you know that banks have two main functions. First is to accept deposits and the second is to give loans. Now we will understand the role of banks in the money multiplier process with the help of an example. Suppose a person comes to a bank and deposits $1,000. Now whether the banks keep all this money with themselves or they give all this money on loan to earn profit? No, the banks cannot do so that they give all this money of $1,000 as loan, because if they suppose give $1,000 as loan, suppose they give all this money as loan, then what will happen? Suppose I go to bank, I have deposited $1,000. Now the bank has already given all this money as loan. Now the bank is not having any money with them. So now when I will go to bank to ask for money, whether they will have anything to give me in cash or otherwise? No, because they have lent out all the money on loan. So to avoid this type of situation, the central bank in each and every country has mandated or made it compulsory that commercial banks must have some reserve ratio. That is, they must keep aside some percentage of their deposits as reserves, which has to be in the shape of cash or as deposits with the central bank. Normally, the reserve ratio is 10%. So now, this deposit of $1,000 has been received. So we here assume that reserve ratio is 10%. Reserve ratio is 10%. So after keeping $100 in reserves, the banks will give $900 as a loan to say a person B. So now, for what purpose the B has taken the loan from the bank? He may have to pay off some debt, or he may buy some goods from some person, or he may have to avail the services of some person. Now suppose this person again spends this money to buy the goods or services from C, buys the goods and services from C. So this money, which is the $900, goes to C. Now person C has his account with say same bank or some another bank. So all this money gets deposited into same bank or some another bank. So this loan becomes a deposit for the same bank or for the another bank. In the same way, the said bank who receives this money as new deposits will again keep 10%, that is $90. 10% of $900 as reserves and will give the balance, that is $812 as loan. So this person C will again buy the goods or services from say person C, say person D, and D person will again deposit the said amount in his bank, which becomes a new deposit for another bank, and in this way again reserve ratio of 10% will be kept, and in this way the process goes on many a times. This is the money multiplier process. Initial deposit is only $1,000, and here you can see that reserve ratio is there in each case. These are the deposits which are being created on the initial deposit of $1,000. Here it is created, here it is created, here it will be again created as 729. Here again $72.9 will be kept as reserves, and this process will go on. So on the initial deposit of say only $1,000, the money supply will increase many a times. This is the whole process is money multiplier process. Money supply in the economy increases many-fold through the banks. So now we will understand the role of banks in the money multiplier process in theory. Here is step-by-step explanation of how banks contribute to money multiplier process. First is deposit creation. Individuals deposit money in the banks. Banks are required to hold a fraction of these deposits due to fractional reserve banking as reserves. The remaining portion is known as excess reserves. Some portion of the deposits is kept as reserves and the balance is known as excess reserves. In the earlier example, this part will be known as excess reserves. The banks lend out the excess reserves to borrowers, creating new loans, and these new loans, when the borrowers make use of these loans to make purchases or investments or pay debts, the money often ends up as deposits in other banks. This cycle of lending and redeposit, again lending, goes on, creating more loans and deposits. This cycle of deposit creation, lending, deposit continues, which multiplies the initial deposit, leading to a larger increase in the money supply. This phenomenon is known as money multiplier effect. One question may come to our mind, whether on the initial deposit of say $1,000, whether the money supply can increase by say $1 million. No, it cannot happen so. Money multiplier process is not an indefinite process. No, it is not so. The money supply in the economy will increase only to the extent of money multiplier, and the money multiplier depends on 1 hour reserve ratio. That is, if reserve requirement is 10%, then the money multiplier will be 10. That is, on the initial deposit of $1,000, the total money supply will increase by 1,000 into 10. That is, total money supply will be $10,000. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.